Hey guys, and welcome back to the Ginger Realtor Show. It is Mortgage Mondays, and we've been away for a while, so let me explain what's happened. We were in Virginia and New Jersey. We've dropped Virginia. We've made the move to Florida, and we're now in the Tampa area. We've now teamed up with Mike Longman, who's with the mortgage firm. Mike, thanks for joining us.
No problem. Thanks for having me.
So, Mike, it's been a tumultuous 12 months in the mortgage world. Interest rates seem to want to go higher and higher and higher. Where do you think we are right now with mortgage rates, and where do you see it going in the near future?
I mean, it's tough to say. I guess it depends on what you listen to and what you watch. But it's I'm predicting we probably got another 6 to 8 months of this. Not necessarily going up any higher than they are right now, just sitting stagnant where they're at. I think they are going to start to trickle down. Next year, second half of the year, which would be great. I mean, it's going to create a little bit of a frenzy. It's going to be one of those be careful what you wish for type of things, because we all know that if rates plummet, it's going to be a feeding frenzy out there in the real estate market, and then you're back into your multiple offer situation. And there's good sides to both markets. It's steady and busy right now. If rates go down into the fives or six, I mean, everybody's going to refinancing, which is great for the mortgage people. Doesn't do too much for the realtors out there, but it'll really create a feeding frenzy where a $350,000 house could be selling for $425,000. So I mean, I don't know when you moved here, when you came down to Florida, but you were here for that, right? Weren't you here for that?
No, so I was Virginia for that. So we started the whole COVID thing when it went down from high fours, low fives, down into the threes and into the twos. I was New Jersey. 100. Yeah, it was hellish up in New Jersey. You couldn't get a minute's peace.
Yeah.
And then Virginia was equally the same. Where I was much more of a rental market because of the military bases. But I'm seeing here with the buyers that I'm working with right now, they're itching for lower rates. And in a lot of the cases, we're itching for inventory as well. But I don't think we'll ever see those twos for a long time if we see them again. But I think if the market settles back down into that mid fours where it seemed to be comfortable for a few years, I think it'll definitely get interesting for realtors and mortgage brokers.
Yeah, it's going to be a very, very interesting 2 years, I think. And I'm excited to see what happens. I've been doing this a long time, as I'm sure you have as well. 23 years in this business, and you've seen all different types of markets I have, and it's going to be an interesting time. But you had mentioned to me a couple weeks ago, you talk about biweekly payments on mortgages, and it's funny that you said that because I was in the middle of, I just recently moved myself, and I was telling my wife to set us up on biweekly mortgage payments, and then you asked me, so I did a little bit of more research on it. It's a great way to, I mean, right now saving money's tough for people. Finding a way to knock 7-8 years off your mortgage, it seems like it's almost impossible, it's the inception of your mortgage. If you started at a 15 or a 20, then you're committed to those payments, those high payments. And there's it's if you have a rough month, or you need a roof, or your car breaks down, or your two kids go to college, and all the things that life throws at us, you're committed to those payments, and sometimes it can get tough. But with a biweekly payment structure, you can obviously, you want to do it on a consistent basis, but your feet aren't held to the fire with it if you set it up on your own. So biweekly payments, it's a way, if people aren't aware of it, it's a way to knock 7 or 8 years off your mortgage. What you basically do is if you have just say a $320,000 loan is what I wrote down. You make basically 12 payments of $2,128 is what it comes down to at a 7% interest rate right now for your standard loan. If you, instead of making the 2128 times 12, if you make 1064, which is half of that, times 26 every other week, basically what you're doing is you're knocking 7 to 8 years off your loan. And then even more importantly than that is the amount of interest that you save. At the first way, of the standard way, which we all are accustomed to doing, making 12 payments a year, you're paying $446,000 and change in total payments on that loan. Where if you do a 26 payments, you're paying $336,000. So it's a massive difference. It's a difference of $110,000.
Yeah, and obviously over the course of a mortgage. Yeah, it's crazy how just making those little extra payments. And most people in the US get paid bi-weekly anyway. So if you just make that payment into your mortgage, and I know sometimes it can be tight, especially with higher interest rates, and payments on mortgages have been a little bit higher than people were expecting them to be. But to be done with your mortgage in 23 years as opposed to 30, that's 7 years of free living.
Yeah. And when you're at my age, those are some pretty important years. You know? I was thinking about that the other day. I was doing my morning walk and I was like, I must be crazy. Like I'm 50 years old and I just went into a 30-year mortgage and we gave up that 2% interest rate to move. You know, we had 1.99% on our old house and we moved in and did not get 1.99% on the new house. But you know, moved in a year ago. But it's you know, it's something that we're going to set up. We're going to set it up and just knock it out and hopefully outlive the mortgage. You know.
That's the thing. I mean, my wife and I, having just moved to Florida, we haven't bought yet. We didn't know what part of the Tampa area we wanted to be in. We got quite lucky with where we're renting at the moment, so I think we're probably going to live in this development long term. But I figured that another year or two from now, we'll take our time to find the right house. I want something with water, which she wants a pool, so it's a case of finding that kind of that property. So I'm going to be looking at exactly the same thing, pushing 50 and signing up for a new mortgage.
Yeah, yeah. So it's definitely something that everybody should consider. And it's really not that. When I first brought it up to my wife thought I was saying every 2 weeks make a full mortgage payment. So she was
Hey,
like,
if you can afford it, do that.
well, that's what she was thinking about it. She's like, I don't know, I don't know, maybe. And I'm like, she's like, can we afford it? And I'm like, it's not that much more. She's like, it's double. And I'm like, what are you talking about? She's like, if you want to make our mortgage, you want me to make our mortgage payment every 2 weeks. I'm like, half of our mortgage payment every 2 weeks. Yeah. And she's like, oh, she's like, well, let me see if we can afford that. I'm like, hey, if you were questioning the first scenario,
Yeah.
there's no way you can't afford the second scenario. You know, so it's so hopefully she'll you know, call them up and set it up. And you know, I mean, obviously you can just make the payments on your own and do it if you want to. But it is a great way to save $110,000 on your standard.
Yeah, because what you don't realize as well is the amount of the principal decreases, so the interest on that, although it stays the same, the amount that goes to principal versus interest decreases. So yeah, it works well. But Mike, look, it's been fantastic having you on. I know we mentioned rates right at the beginning. If someone's shopping around for a mortgage right now, where are you right now on say 30-year conventional?
30-year conventional, you're going to find yourself. I mean, it's a kind of a loaded question, which so obviously every scenario is different. But your standard cookie cutter vanilla loan, you're going to find yourself in the low to mid sevens. What I like to do is I like to go over my entire rate sheet with clients right now because points are like taboo. Everybody always used to say, don't ever pay any points on your loan. Well, right now, all the investors, they're kind of steering you towards that. So I like to find out, A, how long are you going to stay in this house? If they're going to stay in it, you know, everybody says I'll be there for 30 years, but we all know that's probably not factual. But you want to figure out if you're going to pay points to get yourself a palatable rate, you want to make sure that you're going to stay there long enough to get that benefit. The worst thing you can do is say I want to pay 4 points and get 6% or 5%, and then they decide to move in a year because that money's gone. You know, so I like to educate people and make sure it's the right thing for them. And hey, sometimes if you take that higher rate and you don't pay the points because you know you're moving in a year or two, in the long run, it's the right thing to do.
No, I mean, I'm looking at properties right now that we have with Line Right, and we've got guys who purchased a home a year ago, and now the company's saying, okay, you've got to return to work, so no more remote working, and now the commute's unpalatable, and they're selling the house a year after buying it.
Yeah.
So you got to know what you're doing. You got to realize that 5 to 7 years is on average how long people stay in a home. So if you're definitely at the beginning of that kind of property ladder, don't expect your first home or your second home to be a 30-year rest of your life property.
Yeah. Yep. Absolutely. It's a funny time right now. We got a couple new products that just came out. We partnered up with a Florida-based bank. We have a doctor's loan right now, which is fantastic. So if anybody's looking for a doctor's loan, we do 100% financing, no PMI, up to $1 million on a doctor loan. Yeah,
I am going to go start looking for doctors.
Yeah. So It's a great loan. The big thing is you can't be a doctor for more than 10 years. That's the one little catch.
For more than 10 years. So you got to be a junior doctor with less than 10 years experience.
Junior doctor or physician's assistant or something like that. But I mean, no money down, no PMI is great. That same bank also has an untouchable jumbo product for you don't have to be a doctor. You can be anybody. Their jumbo product is fantastic as well. So no PMI on that as well. So we got some new products out.
Let's talk about those on the next episode.
Yep.
We'll give you an opportunity. I'm going to speak to you though about that doctor's one in the meantime because, hey, if it's that kind of loan, it's an easy sell. So hey guys, look, thank you very much for stopping by. I'll have Mike's information below him, so you'll be able to reach out to him if you're in the mortgage if you are looking for a mortgage right now. Excuse the tongue. For now, Mike, thanks for stopping by, and we'll see you in a couple of weeks.
No problem. Thanks, guys. Have a great weekend.
Cheers, guys. We'll catch you soon.